Hello everyone. Let's today start discussion on the credit risks fundamentals, where we discuss the concepts of credit risks, types of credit risks, and the credit life cycle for the credit risks. So I'm going to create videos for you guys where we are discussing with the credit risks, market risks, or the operational risks, or the liquidity risks. So first we should start on the credit risks, and then further we will move topic by topic. So in this slide, guys, we are going to look for the agenda of this presentation. We will look what is a credit risk, what things are involved in the credit risk, and how the credit risk is different from the market risks or the operational risks or the liquidity risks. Then we will discuss on the types of credit risks. Then we will discuss on the credit risk life cycle, how it work, and why the credit risk is important for the bank NBFCs, so why they are need to calculate the credit risk, and then we will lastly discuss on the key takeaway from this presentation. So let's start discuss on the what is a credit risk, guys. Whenever the bank or financial institution, you can understand the main or the core business of the bank or the financial institution. They bank will take your money and give someone your money in the form of loans. So bank will always pay you less rate of return and take higher rate of return from the borrower of the money. So that's the difference between the rate of interest is the core business of bank, and bank earn from this money. Okay, so the credit risk is a financial loss due to the borrower or counterparty failing to meet the obligations. So a bank will give someone loan and they have a obligation to pay the in the form of repayment in the form of some amount of principal and the interest. So whenever you take any kind of loan, so you paid some EMIs, monthly EMIs or quarterly EMIs to the bank. So there some part of the interest rate and some part of the your principals. So that's if you fail to do the repayment of such thing, so that thing will happen in the credit risk as a credit risk part. And then the central risks faced by bank NBFC and the financial institutions, so that's why they need to manage the credit risks of their customers, how that customer is eligible for to take the credit, how much amount they will need to get for anyone can get the bank, and bank will on the basis of their data or their nature of job or the business or the age, they will give the amount, or they also do the is that person is eligible for to give the loan or not. So then manage through the policies, model, limitation, and monitoring in the credit risk. So let's move on the next slide where we are discuss on the type of credit risk. There we generally more focus on the four types of credit risk. First one is a default risk, second one is a counterparty risk, third one is a concentration risk, and the fourth one is the country and the severing risk. So these are the four types of risks, and let's discuss step by step each kind of risk. So first one is a default risk. So whenever the bank face borrower fail to repay the principal or interest, I already told you, whenever the EMI gets start after 1 year, after 2 year, the borrower which are not able to pay the principal and the interest rate of a bank, so that kind of risk we consider as a default risk. Most common from the credit risk. So most common part of default risk is a credit risk. It's and the common it's most of time will happen. So that's why bank need a credit analyst, credit reviewer, or the credit monitoring, credit transactions. Bank will verify that and bank will do that thing. And the default risks will bank will use the matrix or the measurement done by the probability of default, loss given default, exposure of default, and the product of all these things, probability of default, loss given default, and exposure of default, are the expected loss. So that's will we will discuss on the formulas and all these things in the upcoming slides. What is the probability of default, what is the loss given default, what is the exposure of default, and how you we calculate that thing. So all these things we detail in the upcoming session. So example of retail loan, corporate default loan, home loan, bike loan, or any kind of loan which you take. So that's the loan. Okay, so that's the part of the default risk. So let's move on the important topic, that is a counterparty risk. So the counterparty risk is also part of the credit risk and risks arising from the financial contract. So there are the between banks or between NBFC or bank or NBFC or the organization to organizations. There will several co- contract will happen in terms of the loan, borrowing, and giving. So, whenever the bank or the financial institutions or the financial contract fail to repay the principal and the in the interest rate, so that's kind of risk is the counterparty risk, and it's applied to derivative, interbank lending, or the FX trade, or different kind of the classes of the assets that will apply in the derivative, interbank, or the FX trading, currency trading, valuation trading. That thing will happen there. And then the counterparty may default before the contract maturity. It's obviously any time from the start of the, once we pay the sanction amount to the counterparty, from that point to the maturity of that contract or the end of entire duration, that repayment will happen from the interest rate and the loan amount on, and before that any time contract will the fail, and then he will need to calculate how much the recovering capacity that bank will have or that financial institution will have. And that the example of counterparty default, I already told you, bank to bank exposure, bank to NBFC exposure, NBFC to bank in exposure. So let's move on the next and the very important topic, that is a concentration risk. So it's an also important, guys. So the basically the concentration risks may appear or may happen due to the exposure concentrated to one sector, borrowing, or the geography. So whenever we are getting the more bias, whenever we think more on the one particular sector or the geography or borrower, and you invest in that area more amount, or the investment, if there is some natural disaster or anything that is unexpected, or the borrower might not interested to repay the loan, that is also thought of the borrower is also most important, guy. And it is the very difficult to calculate such factors or identify such factor, but we are lost the money, bank will lose the money, NBFC will lose the money due to the concentration risk. So they need to diversify their portfolio, they need to invest in that different portfolio or the different things. Lack of diversification increase the losses. So they need to diversify huge amount in the different sectors. If you have the 100 rupees, it's considered in the bank 100 crore rupees, so bank need to invest that at least 10 to 20 different sectors or different geography or different kind of ballers. So they need to minimize the concentration risks, we manage through the exposure limit on example, high exposure to real estate sector, or the single sector in the banking sector or the healthcare sector, high exposure and high amount they will invest in the single sector, and might be chance to due to the political impact or other impact, that sector will get lost and you lose your money, or a high probability to lose your money. So let's move on the next slide, which is a country or the sovereign risk. It is also part of the concentration risks we can consider. If we invest in single country or huge amount, and due to political changes or due to the natural disaster, anything will happen, then you lose your money. So risks due to the economical or political instability. Co- Correct. If you are investing in some country and there the political things or there the entire political structure will change, and they launch different kind of policy that is not suitable for your terms and conditions while you are giving the loan to that country, and it is a very challenging task for you while you facing such kind of chance. So that's the important, the soaring and the country risks the bank or the financial institutions will face while lending the money. Government may default or resist to repayment of that. The government might be there huge chance the government not able to payment done your the loans amount, and the affect the cost border lending and the saving debit crisis. So it's the use amount, so you need to do the interest rate swap, or you need to do the uh, uh, cover the loans or that thing we need to if we face the soaring risk. So let's move on the most important, guys, you need to understand this thing very well, the credit risk life cycle, how the credit risks will work, and what are the stages are involved in the credit risk. So first one is organization, appraisal, then we sanction, then we monitor, and then we resolution. So one first we will do each step, and there is a certain meaning of each stage. So let's discuss on that credit life cycle step by step. So first we discuss on the organization. So in the organization stage, we customer acquisition and loan application. So we need to identify the potential customer from the market, and then there fill the loan application, check there the civil score, check there the impact there, the loan paying capacity, loan repaying capacity, or is that customer is eligible for that loan or not loan. That all things we do in the organization stage. So data collection, KYC, income, financial statement of that customer, analyze that customer and do initial eligibility check of that customer, where we use AIML techniques to identify that customer is a fraudulent or not fraudulent, or what should amount we should provide that customer. So we use the classification technique, is that customer fraudulent or not fraudulent, or we use a regression technique, how much amount that customer should eligible for to providing the loan. Then we will do the appraisals for that customer. So where in the appraisal stage we should do the detailed credit analysis of that customer or that bank or that financial institutions, or then we do the financial analysis and cash flow assessment, how that the prepayment capacity, how there the financial structure, how that fit into the financial market. So we need to do the all kind of document review and the credit scoring and the rating model. So we check the credit score like a civil score or other scores of that customer, or is that eligible, or is that have the repayment capacity. And then we first lastly we discuss the identity risk identification, how much risks we have, because that part will help us to identify the appropriate rate for the each customers, because there is a n number of banks in the market or the financial institutions, they will pay the loan to the loan to the borrower or the institutions. But we need to, and the basis of their the risks, but we need to acquire the customer, it is also challenging, but we need to check is that this customer is eligible or not eligible. So it's a very challenging task. So that's why we need to do the risk identification. Let's move on the next third part, that is the sanctions, which is and also important. So in the sanction thing we will check the credit approval based on the risk assessment, how the risk of that customer, on the basis of risks we will define the how much amount we will go to pay that customers, or to take the collaterals for that, the loan term and the covenants finalizations, we do that thing, and then approve and as per the delegated authority. So we check that things, we sanction the loans terms and the covenant finalize and approve the per due diligence authority, and then we will sanction the amount to the borrower. So let's move on the next which is the monitoring, which is the second last thing before the resolution. So in the monitoring we continuous tracking of borrower behavior, how their repayment capacity is, they make a timely payment or is there any default. Then we need to change the terms and condition, or we, if he's not able to timely repayment the principal and the interest rate, then we will might be chance to change the rate of interest. Then we will send early warning signals. There are the EWS 0, EWS 1, EWS 2, or EWS 3. So EWS 1 we send to the borrower in when the 0 to 30 days of default of that borrower, or EWA 1 we say in that if borrower is default in between 31 to 60 days, and EWA 2 we say in that 61 to 90 days, and 91 to uh third two or 200 day. In that duration we send the EWS 3. So there are the three early warning signals we need to send to the default borrower. And the covent and the monitoring and account review, we should do such kind of account. And then the resolution. So how, what are the resolution techniques, what are the techniques that used by the bank to resolve that account? So action take when credit quality deteriorates, different kind of action they will take. And the restructuring, recovery and legal action they will take, and object to minimize loss and maximize the recovery will done by the bank or the financial institution. And the key takeaway from these slides, guys, it's and the most important, so credit risk is one of the core risks in the banking, so that need to monitor or the mobilize or to check or the review the credit risks. It's the most important risks in the bank, and bank should have their norms or the some terms and condition while providing the credit risks, or their rules, their logics in their system while providing the credit risks. Multiple type of credit risks require different controls or the different things or different techniques they will analyze or apply the different kinds of the credit risks. And the effective management across their entire life cycle and reduce the losses of credit risks, or to more focus on the credit risks and how they will help to a bank will get the timely repayment or the principal or the interest rate from their borrower. So that's the strong monitor prevent future from the credit risks. And then lastly, I'll request you guys, if you like my video content or my video, so please do like and subscribe my channel, so that will motivate me to create and more videos such you guys. And also, once again, guys, comment your topic and follow me more management concept topic, and I'll continuously create such videos for you guys. Once again, thank you so much, guys.